employee ownership trusts following the 2024 budget. John Kavanagh. Welcome to the UK Tax Podcast. My name is John Kavanagh and I am a chartered tax advisor with my own private practice. I mainly advise other professional advisors, but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. This is the first in a series of podcasts on various tax topics, covering both familiar areas and more recent developments. In this episode, I'll be looking at what's involved in selling a business to an employee ownership trust, or EOT, with a particular focus on the changes introduced in the October 2024 budget. I'll also explain what sellers need to consider in order to meet the conditions and avoid losing the tax relief. An EOT is a specific type of employee benefit trust that holds shares in a company for the benefit of its employees. The concept was introduced into tax legislation in 2014 to encourage employee ownership and provide an option for business owners who want to pass their company on to employees rather than sell to an outside buyer. One of the main tax benefits of selling to an EOT is that the sale can qualify for full exemption from capital gains tax if the conditions are met. After the sale, the EOT must have a controlling interest in the company. This means it must hold more than 50% of the share capital, voting rights, and profit entitlements. Companies owned by an EOT can also pay employees annual bonuses of up to £3,600 free of income tax, and from October 2024, directors can be excluded from these bonuses without breaching the statutory equality requirements. The 2024 budget has made several changes that increase compliance requirements and therefore tax risk for sellers. One major change is the extension of the clawback period for the CGT exemption. Previously, if the EOT failed to meet the stipulated conditions, the clawback period ended at the close of the tax year following the sale, so there was a 2-year clawback window. Now the clawback period runs until the end of the 4th tax year after the sale. For example, if you sell your shares in January 2025, HMRC could withdraw the CGT relief as late as April 2029 if the EOT no longer meets the conditions. Other changes include a new requirement for the trustees of the EOT to be UK residents at the time of the sale. More significantly, there are now restrictions on former owners retaining control of the EOT. More than half of the trustees must be independent of the former owners and their connected persons. If this condition is breached at any time after disposal, it constitutes a disqualifying event and could result in an immediate capital gains tax charge. There is now also a statutory requirement for the EOT trustees to ensure they do not pay more than market value for the shares. This means that a proper valuation must be obtained before the sale, and if interest is charged on deferred payments, it must not exceed a reasonable commercial rate. The budget also confirmed that contributions made by the company to the EOT to fund the purchase price will not be treated as taxable distributions provided they are used to repay acquisition costs. A critical issue that sellers must be aware of is the concept of continuing control. To qualify for the CGT exemption, sellers must relinquish control over the company and also the trust after the sale. Sellers must therefore not retain any direct control, such as a decision-making role in the company, or indirect control, such as putting restrictions in the sale agreement that limit the independence of the trustees. If HMRC decides that the seller has retained control, the tax relief will be withdrawn. With the longer clawback period, this risk has become considerably more significant. There is also an important interaction between the clawback period for EOT relief and business asset disposal relief, or BADR. BADR offers a lower CGT rate on the sale of qualifying business assets, but the claim must be made within 12 months following 31st January of the tax year in which the gain becomes chargeable. If the EOT fails to meet its conditions late in the clawback period, for instance 3 or 4 years after the sale, the window to claim BADR will already have closed. If this were to happen, sellers could therefore lose both the EOT CGT relief and the opportunity to claim BADR, leaving them exposed to tax at the full CGT rate. That said, sellers should obviously very carefully consider how to ensure ongoing compliance with the conditions without creating the appearance of continuing control. Oversight mechanisms may be necessary to ensure the EOT remains compliant, but they should not involve the seller directly. For instance, independent professionals could handle audits or governance reviews and report directly to the trustees, keeping the seller at arm's length. Sellers should also consider including indemnities in the sale agreement to protect themselves financially if the EOT fails to meet the conditions. However, these indemnities must be limited to covering tax liabilities and should not give the seller any role in managing the trust or the company. Another option is to include compliance requirements directly in the trust deed, which ensures the trustees are responsible for meeting the rules without involving the seller. It's also important for sellers to think about their role in the company after the sale. While they can stay on as employees, consultants, or even directors, they must avoid anything that could imply control. Sellers also need to consider the holdings of connected persons, such as family members or business partners. Together, the seller and their connected persons must hold no more than 5% of the company's share capital or voting rights after the sale. Failing to meet this condition could be very expensive in terms of the CGT exemption. Aside from tax, there are practical matters to think about. EOT sales often involve deferred payments, with the trust paying the consideration for the shares over time using the company's profits. This obviously depends on the company remaining financially stable in the future. Employee engagement is also crucial, as the success of the trust and the company depends on employees understanding and supporting the EOT ownership model. For smaller businesses, the costs of setting up and running an EOT can also be a significant factor, so it's worth considering whether this option is suitable. Access to third-party finance can be difficult, as lenders often require security that EOTs may not be able to provide. To summarize, selling to an EOT can provide a means for sellers of companies to pass on their business to employees while benefiting from a potentially very valuable CGT exemption. However, the changes introduced in the 2024 budget mean sellers need to be even more careful than before about compliance. Relinquishing control, structuring the sale correctly, and ensuring the trust meets its obligations are essential to secure the tax benefits and avoid risks during the extended clawback period. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next and future episodes.